Hey folks, I want to do a spontaneous video on how I built a regime switching model using GPT in about 45 minutes. I'm going to share with you how I did it, the limitations and the opportunity around using AI. I think AI has a lot of opportunity on the back end and to enhance decision making. Um, it was fairly easy to do, but you have to have expertise. You have to know what you're doing. You have to spot check the AI. You have to have clean data as well, although it can clean data itself. So what I did first is I uploaded a data set. I'm going to share this data set with you here. This data set consists of the factor returns for the US equity market going back to 2014. And so those are factors like momentum, earnings yield, ROE, dividend yield, volatility, and quite a few other factors that explain the betas or what drives stock market returns. Okay, so I'm going to share a window of what that data looks like so you get a sense of that. So here's the data set. Now I already have this clean data, so I don't have to worry about this. Half the battle's getting clean data. But you can see those factors and you can see the returns on these factors. Simple way to think about a factor is if you have a factor like dividend yield, this time series represents the daily return from being long stocks in the upper percentile of dividend yield and short stocks in the bottom percentile, decile of dividend yield. So it's a market neutral basket. I'm moving quickly through this, but I want to give you a sense of that. So what's driving markets today are momentum. So you look at momentum going back recently to February 29th, just a few days ago, you can see positive momentum here. And so what I want to do is ask GPT to identify 4 different market regimes based on all this factor return data, number one. And number two, help me identify what factors I should own in my portfolio based on the market regime that the model detects. This is just building off of this tweet I did yesterday. So let's go to GPT and take a look at what we've done there. Let me share my screen. I'm in GPT. I've uploaded also this S&P 500 return data. I just got this from Yahoo, open, high, low, close data. You can see it processes that data. I'm going to walk you through the interaction I have with the GPT, show you the visual output it generated, and it's also going to share the cluster identified and what factors work well today. So stay tuned. So it uploads the S&P 500 data. It uploads the factor return data, and it does a merge between these two data sets. So it brings in the S&P 500 return data and it brings in the factor return data. So far, so good. Then I ask it to create 3 look-ahead variables for the S&P, 5 days ahead, 1 month ahead, and 1 quarter ahead. Because at some point, I wanted to make forecasts based on the current market regime. All right. Then I say, I want to move to model building phase. So I say, hey, look, by the way, these S&P 500 returns, these are non-stationary, and there's this term in statistics called heteroscedasticity. What that means is you can't use a normal distribution. The means, the sample means the average returns change, number one, and the volatilities change and the correlations change. So I'm giving the model some direction, giving GPT some direction. Then I ask it, well, okay, what technique would you use? So it comes back with 3 answers. It says Bayesian, clustering, PCA. These are machine learning techniques. And it gives some pros and cons, and it gives very good answers here. And then I say, okay, let's go with your recommended approach. And then it lays out the process, ask what steps are involved. Okay, I won't walk you through all the steps. But the first step, of course, is defining what is a regime, what's the objective. So I say, all right, let's start with that regime question. What questions do you have for me in terms of how to define the regime? So it says, well, here's some ways to think about it. And then I specify my objective. I say, look, I want to figure out whether we're in a blow off top market condition, consolidation, bottoming condition, correction, I want to position my portfolio. My secondary objective is to determine what factors I want to own. Do I want a momentum? Do I want to own high short interest and high volatility? Those are the three factors that are working right now, the last month, I would say. And I also want to know the risk and return considerations in the markets. So sometimes markets can offer attractive return opportunities, but you might be taking on more risk to capture that attractive return opportunity. I call that the devil's bargain, meaning the return tomorrow is very high, or the probability of return tomorrow is high, but the probability of return 1 quarter from now might be low. So I want to see if I can tease out those dynamics using this model. So I give it my objectives, and it says it comes up with this framework. It has a model that it proposes for identifying market conditions, another model for identifying the right factor, and then this risk return analysis. And then it wants to build all this into a single analytical framework. This is like the gold star. This is like the NASA answer, what it produced, right? It wants to use time series classification models or state space hidden Markov models, potentially Bayesian. This is the state of art in machine learning statistics, by the way. So it's got like the PhD answer on this thing. So good job, GPT. The problem is that, as a practitioner, you know that if you have nested models, you're going to have mistakes and errors because all models are estimating reality. All models are bad. Some are useful. And if you concatenate these models together like a Russian doll, you're going to have errors propagate. And the primary model, if it makes a mistake, which again, all models make mistakes, are going to drive those errors into subsequent models. So I say, look, let's keep it simple. I'd rather have a single model that accomplishes all these objectives rather than multiple nested models. So it says, okay, let's go do this Bayesian state space model, which again is a pretty complex model. So, all right, let's go ahead with that specification. So a model specification helps you identify what are the parameters for the model. You're determining the architecture of how it's going to model historical and future stock price returns. Okay, so it says, okay, here are the key things we got to go figure out. There's a lot to do here. First is defining the model structure. We just specify the model. What are the numbers of parameters? How many clusters are there? How we estimate those parameters? And then how do we interpret the results, right? Some ongoing maintenance tasks once you have the model. So I ask, well, okay, how do you suggest we specify these variables? So it gives me a couple different choices, from using market trends, up or down trends, economic cycle phases, liquidity regimes, all sorts of things, sentiment regimes. So it's pretty good so far, right? It's giving good ideas. Sector performance, and then I say, look, let's just focus on the factor performance. That's the data I provided. I provided factor returns. I wish I had suggested focusing here because that's the data I gave it, and that's what I want to focus on. But in any case, I say, look, let's focus on the factor returns. So it says, okay, hey, you provided that data, so we should use that data. Yes. And it lays out the step-by-step process to go build this model. Okay, let's get started. So I ask it to get started. So it says, let's do some data prep, some exploration, historical regime identification, and then start specifying the model. This makes sense. Make sure the data is clean. Make sure we can identify some regimes, do some spot checking before we go build a model, do some exploratory data analysis. That's right. So, so it checks for data cleaning. The data is clean. I gave it clean data. That's good. Then it says, let's do some correlation analysis, some visual exploration. I said, great, let's do that. So it does some correlation analysis on the factors I provided. I can see what factors are correlated with other factors. I won't walk you through this now, but this was useful, had some value in there. I can see the momentum factor, for example, is negatively correlated to value stocks. It makes sense. Momentum and value trade off with each other. If you can find both in a stock, then you're golden. So those are things that we look for. So, I asked to build out some time series plots of those factor returns. I want to look at that over time. That causes GPT to blow up. It can't really do that. It says, hey, can you limit the data somehow? So I said, all right, let's skip that step. Then I say, let's start doing some cluster analysis. It struggles again because the data set is too large. It's only 6 megabytes, by the way, but can't handle that. So I say, okay, let me de-scope this. I say, spit out all the factors. I'll select the right factors for you. So it gives me 20 factors in the data. I select these factors, which is about, a little less than half. I've limited the number of factors to my favorite factors: oil, earnings yield, momentum, reversal, ETF flow, short interest. Okay. So it's still kind of struggling here to handle the data. It's trying to figure out the optimal number of clusters. So let me share my screen again and walk through what does that mean? What are these optimal number of clusters? What's that about? So here's a good visual description. This is from a paper about regime switching that Andrew Ng wrote back in 2011. This black line represents the historical distribution of market returns. You can see it's got a left tail, a fat left tail, and it doesn't really exhibit a normal distribution, right? So this blue line is one type of regime, and this red line represents a different regime. These are two clusters. So if you can partition stock market returns into these two clusters, you're in the blue cluster, then you should have a good net long exposure. If you think you're in the red cluster, then you have to think about risk more carefully, right? These are two clusters, but I want 4 clusters because I want to know, broadly speaking, are we going to go up a lot, up a little, down a little, down a lot? And I think 3 or 4 clusters are more intuitive, right? You have corrections, you have blow off tops, you have grind ups, you have grind downs in general, right? Just using my intuition here to help inform the model specification. I think 2 distributions doesn't really reflect reality. I think 4 is better. I also want to avoid doing more than 4 clusters because I might be overfitting the model, right? So 3 or 4 is probably going to be a better decision. So let's share this screen and go back to GPT. So far I'm like 15 minutes into this, by the way, not bad. So it's getting some error. I say, okay, there are 4 clusters. It's struggling. It's trying to, okay, now what it's doing is it runs into issues and it's renaming the variables so that it can do the analysis. Now it comes back with these clusters and it's showing me the sample observations from the beginning of the data set. And it's added this cluster column not shown here, okay? So it says, hey, let's analyze these clusters and take a look, like what are the characteristics of the clusters and what works in those clusters. So it spits out for these 4 different clusters, what factors return better? What are the high average values and negative average values? I won't walk through that here. I'll do that towards the end, okay? So I say, build a table showing the typical returns in each of these clusters. It's very important because you have to spot check that your mini analyst GPT did the work correctly. And it says, well, the data set doesn't include the future returns. So I said, hey, look, I gave you the returns data set. You already merged it with the other data set. So GPT forgot I gave this data. We did that in the beginning. So I gave it the data. It says, I can't find the data. I said, okay, here's the data. Go upload it again. Go calculate it. And now it shows me the returns on all the 4 clusters. Now notice the returns are all negative. This makes no sense because from 2014, the beginning of the data set to now, the average return should be positive. So GPT's made some kind of mistake here. So I say, hey, GPT, there was a major bull market from 2014 to the present. How'd you do this? What? It says, you're right. We had a big bull market. So I must have made a mistake somewhere. Maybe it's aligning the dates from the S&P. Maybe it's calculation of the returns. So I said, yeah, go proceed with your investigation. And now I have to help it. I say, show me the returns. Show me how you calculated this stuff. And I say, show me for the month of December, because I know December was bull market up only. So it pulls in these observations. This is the S&P 500 for SPY. So you got to multiply by 10. So December 1st SPY was 4590. End of the month was 475. Bull market. So the future return should be positive, not negative. And the future 5 days I know is also positive. So They say, hey, look, your GPT, you're doing the math incorrectly. Look at the data. So it says, you're correct. I made a mistake. I'm going to go update my calculation now. Apologize for the oversight. Okay. Now it does it correctly. It says 1 month return 2%. That's right. This data makes sense. And it says I can't calculate the quarter ahead returns because we haven't completed the quarter. We just completed the quarter, but I haven't given it data to see that data. So it thinks we haven't completed the quarter. Now this data is correct. We're back. We're rocking and rolling. So I say, hey, validate the data a little bit more. Show me the data from March 2020. This is COVID, and October 26, 23. That was the bottom of the October correction. And it gets it right? The beginning of COVID, the future returns were negative for that first month. There's a bounce back. So roughly flat 1 quarter. And then in October 26, the forward returns are positive. So we're good. So, and it says, these observations align with market events. And I say, okay, go apply that. Let's go back to the cluster analysis. Now, let's recap. So GPT has looked at data from 2014 to current day. It's looked at my factor returns. It's processed 8 factors, and it's done this cluster analysis. Let me explain what this cluster analysis is. Okay, this is an analogy. This is called principal components analysis, statistical technique you learn in school. But these dots represent different observations. This is a 3-dimensional data set. I gave it an 8-dimensional data set corresponding to my 8 factors. So what it's doing is it's trying to find vectors that best explain and partition the data. So here are 3 different vectors. And you can imagine this is a regime. This is like say COVID, this yellow dot over here, March 2020. So what it's doing is it's trying to say, hey, this observation, March 2020, is closest in distance. And you can measure the distance by calculating the distance between this observation to each of these 3 vectors and find what it's closest to. Then you assign it to that cluster, right? So this would be cluster number 3, call it the red cluster. And so it groups all these observations together and gives it a name. It calls it cluster 3. So that's what it's done for all of the data so far, right? It's organized these observations into these different clusters. So, and here it's got 4 clusters. We're back to the data. Now notice a few things. One, the future returns increase monotonically across cluster. If I look at future returns in the 5 days ahead period, actually that's not quite right. Almost monotonically, right? Cluster 0's got the worst 5-day return performance. Cluster 3's got the best return performance. Cluster 1's kind of mediocre. Cluster 2 is doing the best, right? In general, though, the higher the cluster number happens to be the case that the higher the return. Certainly, actually, once again, 0 and 1 are kind of similar, but you get the highest return in cluster 3. So cluster 3 looks pretty good, right? Cluster 0 looks like the cluster you want to avoid. But notice there's no negative returns. Now that makes sense because most of the time we're in a bull market from 2014 to now. If you have 4 clusters, you shouldn't expect to see a negative return cluster because it, on average, is a bull market. And I didn't give it the problem definition of finding corrections. It's a different model. I'm going to work on that model later. But those scenarios are closer to this cluster, probably, I'm speculating. I could have had it report out what are the average returns, actually not the average returns, but the minimum returns in each cluster to validate my hypothesis. And probably the minimum returns here have deep negatives. They probably have lots of left tails here. That's my speculation. Easy to ask GPT, but I ran out of tokens, so I can't ask that question. Otherwise, I would do it right now. All right. But so far, the data looks pretty good. Now, I say, okay, what cluster are we in today? And it says you're in cluster number 1. So we're in this cluster. Okay. So cluster 3 is you want to step on the gas. You want to be net 100% long. That's one way to think about that. All right. Cluster one is, yeah, you should expect positive returns, but it's not as bad as cluster zero, but it's not, it's not full send, right? So I said, all right, show me what the cluster's assignment scores are for the last 2 weeks. So I want to see how stable these clusters are. And you can see on 2015, cluster score was 3, more recently it's 1. So it does change a bit. By the way, guess what? NVIDIA reported after the close on 2/21. And leading up to NVIDIA, the cluster scores were 0. This is something I noticed as well. Like leading up to that week, we saw that Microsoft was trading below its moving averages. Apple had broken down. Oracle had broken down. And Supermicro had broken down. So actually, I had like a heightened sensitivity to market risk going into this, even though we're long NVIDIA, right? I said, all right, things are looking kind of dicey here. NVIDIA reports the day after this, and bull market back on. These are the animal spirits that come back on. We're in regime 1, 1, 1, and then 2. So we're throttling up. And then on, I don't know what happened on the 28th, 29th. So, the point of this is that if you can inform your statistical analysis with knowledge of what's happening in the markets, that can be invaluable. You can think about different ways to extend this. What if you can layer on key economic data like CPI disappointments, PPI, FOMC meetings, or key dates that change the regime and the psychology of the market? Because these models don't understand those events change psychology. So that's the magic of bringing qualitative and quantitative analysis together, which I call quantum mental, which is really the hallmark of what we do at Lumida. It's how do I bring idiosyncratic views, top-down thematic views, factor risk management together to construct a portfolio. So I say, look, let's do something simple. Why don't we create a rolling average of that cluster number of the last 20 days to take the noise out of it, and then plot it over the S&P 500. This is pretty cool. So this would have taken me like 20 minutes. I'd have to export data to Excel. It would have been a pain in the butt, right? By now, it would have been 5 hours have gone by to do all this work. I'm only maybe 30 minutes into the analysis. So the blue line is the S&P. The red line is the average of this cluster number. And remember, in general, the higher the cluster number, the more bullish it is. So what you see here is, when the red number is high, you should be bullish. When the red number is low, you should be less bullish. Not necessarily bearish, because the average returns are higher. We should be less bullish. So here it's saying, full send, bull, bull, bull. It gets that right. Now, again, it's not making a forecast either. I want to be clear about it. It's simply saying, here's the regime we're in right now. I haven't asked it to make a forecast yet. So it's saying we're in full send market here. And here it's saying these are the weaker return regimes. It generally gets that right. Did it get the turning point right? Well, here, it kind of got that risk off or less risk on in that area. So, it was growing more cautious in this area. This is a long period of time. This is like 4 months, about 4 months, right? So those parabolas really suck people in when they get excited. But the model did a good job of saying, this isn't the highest risk reward regime. So maybe you are not net 100% long here. Here, you probably should have been net 100% long if you believe this analysis. Here, it made mistakes, right? It's hard to get the exact date, though. I guess I got to line it up perfectly. And again, the cluster number can change very quickly. I would wager, and we could ask it, I would wager the cluster number changed immediately once it went into here. It probably went from risk on to risk off very quickly, not unlike what we saw with NVIDIA. When NVIDIA reported it went to risk on, there's some event here that caused it to go risk off. And this was around end of July of last summer when the regime changed. And what about October 26th? That's the bottom of the market. It's saying, again, it's not making a forecast. It's saying, hey, this is generally a lower risk reward regime. And it flips within about a week or two. And again, it probably flipped quickly, but because I have it doing this rolling 20-day average, it's not highly sensitive to regime changes. So the average you want to take probably changes depending on if you're Harvard endowment, you probably want to do a 20-day, 30-day quarterly look back. if you're very tactical and you have small positions or small account value, you can get in and out of market. If you're a family office, you want to have a more sensitive look back. You can be more nimble and more tactical. So you can calibrate this. There's a thousand ways you can tweak this, right? And so where it's saying now is, the cluster score is just north of 1. So risk reward is positive. It's always positive, but it's not as exciting as it was over here. It's the same kind of scores as you saw here or here, actually, which makes intuitive sense to me. I think that generally makes sense. Now I ask it, what factors work best in these regimes? I'm actually more interested in that. I'm not trying to use this to calibrate my that long exposure, because market time is extremely difficult. But can I do factor timing? Can I figure out what factors I should own conditional on what cluster I'm in? That's a more practical problem, right? Because I can own 8 different factors, from value stocks, which means earnings yield, to momentum stocks, to stocks that are highly shorted. That would be like Carvana. And their stocks have combinations of these factors. Carvana is high momentum, highly shorted, and some other factor, right? So I say, right, what factors work best in these different clusters? So it says, for each cluster, it tells me what performs best, what performs worst. So in cluster 1, it says you want to own momentum and sales growth. This is really funny. This is like a 2021 vibes, right? Because these are like the hottest stocks. It's saying own NVIDIA, first of all. Thank you, I know that one. But it's saying own like hype stocks. And that's what's working, right? So what's not working? Earnings yield. What are these? Earnings yield are stocks that have high dividends. These are generally value stocks. They're cheap. So these stocks are saying, yeah, you don't want to own that right now. Now, I'm not saying you go ahead and implement this, by the way, because this is actually a good source of diversification against this factor, is one way to think about that. Because these clusters will change and you can get whipsawed. So, portfolio construction is a different kind of problem. So what else? Interestingly, the most productive factor, what works the best, are when the oil factor is improving. I guess that kind of makes sense. When the global economy is strengthening, you can see that in commodity prices. And, you see energy stocks going up. And investors are not focused on momentum and sales growth. Right? This is like meme chasing, really, right? It's saying like, buy the meme, buy the hottest meme. That's actually a better backdrop for returns. And the worst scenario is when momentum and earnings yield go up together. It's kind of interesting. I guess this might be like everything goes up market. This requires more analysis. It's saying momentum goes up, and the opposite of momentum, which is like value stocks, that also goes up. So, this takes more study and analysis, but there's a lot here. And then I ask, how do I say this in the future? I don't want to spend, by now I've done an hour of work on this. Like, I don't want to have to rebuild this whole instance again. And then, I'm trying to do some more analysis, and then I run out of tokens here. I'm not going to use a default model because GPT 3.5 isn't that capable. So I hope that was interesting. Super, super cool, right? You can imagine stringing this together with APIs and a workflow, and then every week, every day, every quarter, you get a dashboard, and it says, here's what your risk posture should look like. Here's what factors you should look at. Here's how your current portfolio is positioned. Here are the recommendations you should make to adjust your portfolio. That is where we want to go with this. We do a lot of that manually now. We can generate the conclusions that GPT already told me. So it hasn't actually added value yet, but I can create some more automation off of that. So I hope you found that interesting. By the way, building these models is extremely difficult. It's very, very difficult. Let me show you the research on regime switching models. This is, I'm going to show my screen again. Share window. This is the 2011 literature. You can see the date modified 2011. These are all the different academic papers that came out. By the way, 13 years have elapsed since then. So the historical literature on looking at factor timing and regime switching is very robust. So if you actually want to build a model like this, you've actually got to spend time reading a bunch of these papers to understand what works. So these canonical papers, you'll see they're identified in this literature. This is one of these, Kritzman's regime switching model, and some others. So, if you want to mess around, you can have fun with it, but I would caution against actually like betting on your conclusions. And the other considerations are, you need to think about out of sample data, because right now I only had the model trained in sample to tell the current regime. I haven't actually said make an out of time forecast based on out of sample data, right? There's so many things we haven't done really quite properly here. I just wanted to move quickly to get a sense of how it sees the current market regime. Very simple question, and that answer can be answered using the approach I described. We haven't done any forecasting yet. I haven't tested, is it good at forecasting? That'd be another test. And then to evaluate that, I have to do like a walk forward model where the model is retraining over a telescopic look back window. It updates the model, makes a step ahead forecast. Then you score that out of sample, measures how accurate it is, and then do that over the last 10 years. So that takes a lot of build up and a lot of engineering to do well. You need like a back tester, right? So anyway, I hope you found that interesting. It's the promise of AI. It still has a lot more to do. The context window is going to be better. It's got to remember more. It still makes mistakes. You still need to be a skillful practitioner to get the most value out of the model, and you need a lot of clean data. All right, hope that was fun. Enjoy your Sunday.